Good morning, folks. So we're just getting started here. This week's episode of Back to the Futures with me, Markets and Mayhem. Hope everyone's had a great week so far. Certainly interesting times in these markets. We are just pushing up to new all-time highs practically on a daily cadence. And certainly looks like we're going to have another one of those days today. We've got a pretty juiced up pre-market. S&P trading up here to 6919.25 as I say this. So looks like it's going to be another bright green day. Markets are juiced on optimism about a trade deal with China. Recall much earlier this year, markets had swooned regarding the tariffs that were proposed. Some had said it was an aggressive negotiating tactic. I was among those. Others had said Trump was destroying the economy. And at a point, it did seem like that may be the case. But really have seen this turned around narrative now being one of reconciliation between the United States and China. And that's helping to drive up the futures. It's helping to drive up commodity prices because that's under the impression that we're likely to see more economic activity. And so it definitely sets up a number of interesting trade opportunities. We also see some leveling out in gold and silver. We had a really powerful rally in both. I don't think those rallies are completely over, but I do think they're doing what I'd hoped to see, which is a period of correction and consolidation. And if you haven't traded precious metals much, one thing to appreciate is they need that. If they don't get that, then often is the case that that's the end of that cycle. So I think we're getting that healthy corrective activity in gold and silver. I don't think the primary catalysts for what drove all of what we've seen so far are behind us. So I do believe we have more room ahead. But for gold, I'm looking at the 20-week moving average, and I'm just going to bring up a chart here real quick to show you what I mean. But I'm looking at the 20-week moving average, and the reason I'm looking at the 20-week moving average as gold grinds lower again today is because I believe that's an area where we could catch some support again. So let's go back to this chart on gold. We can see that really when the rally started to accelerate in 2025, this and I'm just going to pull it out. This 20-week moving average in purple on the weekly chart has been an area of repeated support. So as we correct here, and look, I mean, we're not even that far from where we just were. I know there's some folks that are panicking a bit here. Maybe they're leveraged into gold miners or gold itself. But from what I can see, this is a healthy pullback so far. I'd like to see it actually test below the 20-week and get gobbled up, like aggressive absorption by buyers down there. To me, that would be a really healthy sign that we've got room for continuation and that this was just a temporary setback. Obviously, there's a chance we could pull all the way back to the 50-week, but that's my line in the sand. I do not want to see gold get below the 50-week moving average. If you look at it from a Bollinger Band squeeze breakout perspective, a weekly close below the 50 would be a bearish omen. So for now, still optimistic about gold being able to get to $5,000 next year, probably in the first half, but I think we need to see a pullback to around 36, 3,700 first, some consolidation, and then we can begin that grind higher. And the longer we consolidate, the better it is. That is to say, if you think about energy, think about consolidation as a store of that energy. The longer you don't move, the bigger the ultimate resolution is likely to be. So I'd like to see gold consolidate for months because then that would give me the confidence that that's sort of the springboard for that next breakout. And silver, Kind of a similar look overall, although I think silver could easily pull back to that 50-week moving average. It doesn't play with the moving averages quite as cleanly as gold. Silver is gold's high volatility, more industrial cousin. And this latest move higher really it does have the appearance of a multi-decade breakout, but what we don't want to see is silver stay below 48 for too long. Why? Because that was the prior high. If you go back to 2011, that was where silver capped out that ultimate rally. And the last thing we want to see here is this be just like a kind of, hey, we're going to break out, just kidding. That would be a pretty bearish look for silver. So we still have some time to resolve this better on the monthly, but not much time left really till Friday. So I'd love to see us close October above $48 an ounce. Let's see how that goes. But ultimately, I don't think the story in silver is over yet. The big driver of silver is industrial demand. That is where the majority of silver's usage comes from. So unlike gold, where it is generally used as a store of value and a hedge against uncertainty and to a lesser degree inflation, what you're seeing with silver is much more of a reflection of industrial demand. And the biggest consumer of silver is the United States. The second biggest consumer of silver is China. So we're really looking for both of those economies to also show some signs of life with regards to how silver may perform moving forward. So those are two areas I wanted to look at real quick. Let's also just take a quick look at the futures. It really is up, up, and away on the daily, on the weekly as well. And I've been talking for a little while about seeing these larger trading desks rolling up their positioning to the call strikes at SPX 7000 and saying that that was a sign that these larger trading desks were confident that we're going to close out the year with more all-time highs and ultimately likely around that 7,000 mark. We're kind of getting into that seasonality now. November, December tends to be pretty constructive for the stock market. Most years, those months are up. So you see the roll up of options positioning, you see the market grinding higher, and you see positive seasonality as a potential tailwind. You've got the macro news of China and US reconciliation, a potential trade deal coming out. So a lot of good tailwinds to kind of boost this market. And for now, the market's not really paying attention to some of the fraying narrative surrounding AI. That is to say, there's a lot of idle server capacity, there's a lot of capex being spent without a lot of return on investment or ROI to show for it. And there's growing skepticism in enterprises that have invested in generative AI that it is really going to be the kind of productivity booster that it's been advertised as. Now, my own view on AI is a bit more nuanced. I think it does have the potential to be a force multiplier when used properly, but I do not think it is the sort of holy grail of replacing humans in the labor force as has been advertised by aggressive marketing. And that's the big disconnect between the two. You know, obviously, there's a lot of discussion about how companies are doing these mass layoffs, and that has a lot to do with AI. I would take issue with that. I think it's actually just more of a convenient excuse at the moment, to lay off workers. That's not to say that some companies are experiencing productivity gains, and that's giving them maybe a little bit more slack to lay off some of their workers. But I do think that the biggest catalyst there is simply that companies are seeing more difficult business conditions in many industries, and the cover of AI allows you to fire workers without kind of telling the world that, you're seeing some headwinds that could trouble investors. So that's kind of my 2 cents on it. We'll see how it plays out. Obviously, I think that what's happened in the economy is transformational, but it also does concentrate some risk. That is to say, so much of the economic growth is built on top of building more data centers. And we already have more data centers than pretty much the rest of the world combined. So you have to start asking yourself, how much longer does this story have to play out? On the other side of it, you've got aggressive government deficit spend. That's certainly helping to drive some of the economic activity, and you have the most affluent consumers accounting for over 50% of consumption trends. So those are the three pegs that the stool we call the US economic growth engine is standing on right now. And if any of them get a little wobbly, that's where we have to kind of get a little more concerned. But I think for now, over the next 2 months, notwithstanding any crazy headlines or escalations, we'll probably have just a grind higher with some pits and stops along the way to S&P 7,000. I kind of think we're so close to it, and I've been talking about this ever since those strikes came up on the chain. So this has been like 3 months now, or maybe 3.5 months. We've been talking about S&P 7,000 being a target. It still looks like it's very much in the cards. So I'm going to pull out that window there, and we're going to just go through a couple of different slides here. First, the general disclosure, and really the long and short of this, from my perspective as a trader, please don't risk more than you're willing to lose. That's really the key. And the reason I say that is because I know a lot of people don't give themselves the patience they need to grow into the traders they can be. A lot of people within them have the potential to become excellent traders, but they don't necessarily want to put in the work. Impatience can really hurt your long-term outcomes. And so my advice, A, start small. Start with capital that you're willing to lose, because you may. B, be patient, because this is a journey. This is not a sprint. Trading is like running a business, which means you need money to keep your doors open, which means you can't lose all your money thinking this is the one that's going to be a 10 bagger and just throwing it all in there, especially, God forbid, with leverage, and getting wiped out and then saying, okay, I'm done with trading. The lottery didn't work, because this isn't really supposed to work like a casino. It's really supposed to be more like buying and selling inventory and hoping to capture a positive spread repeatedly. That is the goal of trading, quite simply. So if you're looking at this as, I'm going to quit my job, I'm going to trade full time, and you really haven't been at it for long, and maybe you've had some good lucky trades and you made some money, take a step back and ask yourself, if this was your primary source of income, are you going to be able to pull your emotions out of it and consistently make enough money to support yourself, to support your family, to put away money into savings? Now, if the answer is yes, awesome. But if the answer is no and you have doubt, then it's not time to just quit the job and dive into this. I've seen people get hurt doing that. You have to really be ready. And to me, that means years and years of experience and proven consistent returns, a systematic strategy that allows you to navigate the markets without impacting your psychology negatively. So if you are making money consistently in trading, that's awesome. That means that you found an approach that works for you. That also means it's time to hone in on that approach. What I mean by that is you should be accountable to yourself and your system, journaling your trades, figuring out where your weaknesses may still exist, addressing them, and focusing on your strengths. One thing that is not discussed enough in trading is we are all wired completely differently. What might work for me might not work for you. And what might work for you might not work for someone else. And that's fine. There's a beauty in that. But the big part of it is tuning out the noise of trying to say, oh, well, this guy's got it down, I just need to follow his system. No, we all need to figure out what works for us. Because even if someone else has a great system and it works for them, if we aren't wired the same way, we may not be able to trade it the same way. So figuring out your psychology as a trader is such a crucial underpinning to your sustainability in this endeavor. I can't emphasize it enough. For me, it was about a pivot. I started off as a much more discretionary trader. My trading was mostly focused on, my gut feel and looking at a chart. And I'm talking about starting back in 2005 and navigating through the earlier innings of the great financial crisis. I was purely technical, and it worked for me back then. But what I started to realize were there other forces that drive the market that I need to be aware of. So instead of just trading technicals and going by gut feel and eyeing a chart over time, I developed systematic strategies. I developed models, back testing, basically feeding data into my decision process to take out the gut feel to take out the emotion, to move from discretionary to more systematic. That helped me become more consistent, but it also helped to take a lot of the emotion and grind out of the trading experience. Instead of having my emotional outcomes tied to the outcome of the trade, it became much more neutral. And some might say, well, that sounds boring. Well, you know what? Boring trading is good trading. That might sound strange. Like, you want that dopamine rush. You want that adrenaline. You want to feel like you have skin in the game. That's a gambler's mentality. That's going to get you hurt. Healthy trading is actually the least amount of emotional attachment to how your positions move so you can objectively assess how you want to continue that trade. If you have a system, you already know your maximum risk threshold, you know the conditions in which you would exit the trade, and you can navigate it without an iota of emotion once you start to really become more confident in your system. And that's where the journaling comes in. Because if you build a system, you journal it, and you know it works, then the confidence increases, and the emotion and the uncertainty and the fear and the greed start to become less and less of passengers in that journey of trading. So let's talk a little bit about the weekly pivots we have this week. We're already above both of them. These are my weekly bullish above, bearish below pivots. I put them out on the Traderade Discord every Monday to start the week so folks can kind of get a sense as to where there are lines in the sand. And these are pivots. This week, they are drawn largely from options derived levels because we just keep climbing. So we don't have a lot of market generated information up here in the futures and the volume profile, but we still have plenty in terms of where options positioning is. And if you look at the chart for yesterday, you'll see the price action for the S&P 500 really did have this period of time where it was grinding around the ES pivot before it ultimately decided to move higher. So these pivots can be important, whether they're derived from options, market generated information from volume profile or otherwise, or a combination of the two, because they can also help us to be a little more accountable. That is to say, if we failed that 6883 level yesterday, I would have been inclined to take more pronounced fades, but because we broke away from it to the upside, I was more inclined to take longs, and it's that simple. Having that information available, also knowing where your levels are before you approach the market, can help you to more accurately navigate your risk and reward, decide whether the trade's worth taking, rather than just sitting in front of the screen and hoping, because hope is not a strategy, that that trade hits. The reason I say that is I do see some folks kind of lean more into the I'll trade the market in front of me mentality, but they don't do the work. You do want to trade the market in front of you, but you do also want to do the work, whether you're using automated tools to qualify what these levels are, like the SPX options visualizer or my pivots, or whether you're using your own system, whether you're using volume profile, moving averages, etc. You should always have an idea as to how you want to trade the tape, and you should have an idea for both sides, long or short. But here's the most important part. You should know when not to trade. I know that sounds strange. It's actually one of the most important lessons you need to learn as a trader. When not to trade. And you'll find that once those conditions are met, you're saving yourself not only time, but potentially money and, the energy that you have that you bring to the table, that mental capital. We all need to preserve that time, that real money, and that mental capital, which means the less low conviction trading we do, the better off we're going to be. The more consistent we're going to be, the less we're going to be paying for our brokers' kids to go through college. It's a win-win. So less is more. And this comes down to that gambler's mentality versus systematic approach. The gambler's mentality is, I'm just going to force trades because I see there might be an opportunity here, but really I just want to feel that adrenaline. I really want that dopamine kick if I'm right. That's going to get you hurt for most people. The systematic approach is, I see a signal, it's actionable, the return potential is better than the risk. I'm going to take this opportunity on, and I'm going to stay honest to my signal and the system that tells me this is where I get out of a long to realize my return or to get out because I've exceeded my risk. It doesn't sound as fun, but it can help you become more consistent. And ultimately, that's what matters. Because if you really do want to become a successful trader, you have to optimize your ability to make decisions under pressure, to continually do so without getting ground down to the point that you burn out and start making bad decisions. You also have to be self-aware. If you have a really good run, you can't just go out there and start taking bigger and bigger risks. That is how people blow themselves up. Just like if you get really hurt, you can't try to revenge trade your way back to where you were. That money's gone. You're going to have to earn it again. Hard lessons, but very important ones. And we do have some exclusive deals. Right now, you can get up to 40% off of Bookmap by visiting Traderade.com/bookmap. That's, you can get 40% off of Bookmap by visiting Traderade.com/bookmap if you're so inclined. So we're going to pop out of the presentation here, and we're going to go right into Bookmap. And we're going to talk about what we saw in the overnight session. And as we do that, I'm also going to post these pivots on social media. So just give me one moment. They'll go on my X feed. If you're interested in checking that out, you can grab the pivots there. All right, that's out there on X for folks to check out. And while I'm talking, while I'm doing this presentation on Bookmap, if anyone has any questions, feel free to ask. I will try to get around to them as soon as I can. Just remember, I'm on several different channels, so it can sometimes take a little bit for me to get to them, but I am actively checking and I will get to your questions. Good morning, Low Key. Thanks for tuning in. All right, so let's get to the overnight session on the S&P that we have here on screen. First, yesterday into the close, look at that aggression. That was pretty incredible. Sellers came in repeatedly trying to absorb these aggressive buys and to no avail. So that's an interesting thing to see. When you see that aggressive absorption indicator coming in repeatedly, not really phasing the other party, that's giving you a sense that you've got some potential for this thing to continue, right? So it did. You got that first absorption indicator. You saw the delta buy bubbles get just more and more aggressive into the close, and it really didn't phase the buyers. Sellers coming in, just selling into that buying pressure, didn't have much of an impact till we got to Globex. Then we saw just a little bit of consolidation of those gains, but I think that was a pretty respectful consolidation. That gave us a sense that really there wasn't a lot of appetite to move lower. And once we breached the point of control with some conviction this morning, it's kind of up, up, and away. You could see there was a buy stop run. That means shorts were getting stopped out, 193 contracts worth, and some passive selling into that, a little bit of iceberg passive selling. But overall, as we approach the open in just over 5 minutes from now, it does look like we're set for a continuation of the sort of price action that we've been seeing. S&P futures are bid up about 0.25%, NASDAQ futures just over 0.33%, Dow Boomer Index up 0.6%, and the Russell 2000 doesn't want to party today, down just about 0.2%. Meanwhile, gold down 2%, oil down 1%. Some weakness out there in the other futures markets, but nothing too profound. I do think if we want to kind of switch gears over to oil for a moment, oil is in trouble. And the recent rally it had, I don't think is anything more than another area to reoffer from in the ultimate downtrend that we've seen in crude. So we've talked about this chart a little bit. I just want to bring it back because I know there's a lot of folks that watch oil. This thing has been in a downtrend for about 3 years now. And you can see it with the sort of lower high, lower low momentum that we've had to the downside. This last little pop higher is likely to be another area to reoffer from. I don't think the character of the market has changed, and we still have signs that oil demand is slowing overall. There's not enough geopolitical tension to give it that premium right now, even with, some new developments in Ukraine getting long range missiles and promising to attack Russian refining capacity. I think ultimately oil is headed down to the mid 50s for a bit. It's probably going to grind sideways, build a base, and then launch from there. But I'm not in an immediate rush to get long oil of yet. I really do need to see it make a more meaningful break. And ideally, I'd like to see it break above this 200-week moving average. You can see in the past it had been support. Now it's become resistance. So we really need to see a break above there to get any real confidence that oil has bottomed sustainably. Let's take a look at the overnight session in gold since we've been talking about it a bit today. So this is a pretty choppy overnight. Let's zoom out just a little bit more. Yeah, let's see if we can even pull back, let's say a 12 hours. So give me a second as that load. But gold's been under a lot of pressure. It went a bit parabolic and got ahead of itself. In doing so, I feel like you saw more and more folks betting against it. The amount of put flow into gold futures, into GLD and other venues started to hit a climax. Now, there's good news in that. The good news is that when that put flow gets that extreme, it often helps to build a base. So I do still think $3,600, $3,700 an ounce gold could be a nice base to bid from if we get that kind of fake out breaking below the 20-week moving average and rebid from there. And I also think that the amount of puts that have been bought, as those start to get cashed in, either because they're losing premium or because people are taking profits or both, that ends up being somewhat liquidity supportive for gold overall as well. See if we can pull this back just a little bit more. We got that backfill data. So yeah, overnight session, pretty brutal. Right as Globex opened, there was some consolidation. Then the selling pressure began. There was an attempt by buyers to take us over the point of control. That got sold into aggressively, and it was just really a straight path down for the Asian auction and the European auction. And now we're just starting to see a bid as we approach regular trading hours in the United States. But overall, I still think gold has some weakness ahead. We can have some counter trend pops for this mini corrective impulse. But overall, I'm still looking for gold to get to that 20-week. You can also take a look at Bitcoin. Bitcoin kind of following the path of gold, but earlier. We saw that correction in or that corrective impulse in Bitcoin start yesterday afternoon. It based out earlier than gold, basically when the European auction was starting. And now we're starting to see a rally up to 115,130 per coin. So if this is any indication, some people like to call Bitcoin digital gold, although I'll say the correlation is pretty spurious. But if this is any indication, there is at least an appetite for dollar alternatives growing this morning. We'll see if that lends itself to gold getting a little bit of a pop before it continues that journey lower today. And markets are opening in just about 30 seconds here. And markets are open. Got a market on open imbalance of negative 195 million for the S&P 500. Loki asks, I remember you were attracted to the ticker symbol hack. Has it been bullish lately? I think it's done pretty well. It's looking like it could try to make a larger breakout here, but overall, the cybersecurity space has had interesting opportunities here and there. Another one of the areas that I had liked was CrowdStrike. We actually traded that thing right off the lows, kind of sniped it, and got a nice 20% return pretty quickly. I think that these are areas where you have good companies that can be bought when they have, some kind of news event or earnings risks or otherwise. As long as they still have a solid core business, there's an opportunity ahead in the cybersecurity space. It is a space that is getting a bit crowded overall, but if you're in the leadership stocks like CrowdStrike, Palo Alto, etc., I think there's still upside to come. Oh, looks like there's something wrong with the video on my Discord stream on the Bookmap Discord. I'm going to fix that. My apologies. I don't know what happened there. Should be back now. And James Jr. asks, morning. Good morning, James. How can I figure the red squares and see absorption, please? So that's actually an indicator that I built for Bookmap that's exclusively available on the Traderade Discord, both with visual and audio alerts. So unfortunately, I don't have that available in the marketplace yet, but it is something I'm considering for the 2026 roadmap. So stay tuned on that. And Ships, hey, what's up, buddy? What does it mean when you say we have a market imbalance? So it's basically when the market is opening, there's an imbalance by X amount, buy side or sell side. It just means there's some folks that still have today some selling to do. Doesn't always have a big impact, but it's at least worth noting. And so far, just about a 5-point opening range in the 3 minutes we've been open. I'd love to see the dynamism of this opening range broaden out, ideally to about 15 handles or more, maybe 20. That would give me some confidence that we're going to have a more exciting trading environment. Yesterday, it was really just about like the last 40 minutes of the day. That was where the trade was. Most of the day was a little bit more boring because of how much we gapped up. And I will say those gap up nights, when you get that gap up on Globex, often it leads to a boring Monday. And yesterday, in that sense, was not any different. That is to say, if you didn't go into the weekend long, you didn't really benefit from that from a trading perspective. Obviously, investors benefit, but if you're day trading this market and you come into a Globex session that's already bid up pretty aggressively, you can usually expect that you're going to get consolidation or maybe even a bit of a pullback during the regular trading hours session. And we did until basically the last 40 minutes when we rocketed. It was also interesting because we were watching the call flow for SPX at Traderade, and one of the things we saw in the early morning session of SPX call flow was it was targeting around 6913.75, which is just about where we hit just after the market closed. So you saw there were some call buyers out there that kind of had a sense there was going to be some positive news flow. There was going to be some more confidence about the trade talks that was going to be expressed in the later part of the trading day. And so I will say, follow that flow. Nothing has a 100% hit rate. So anyone claiming they've got a system that does is nonsense peddling. But following the flow of SPX has been one of the more reliable ways to navigate that intraday tape and that also swing time frame tape, quite frankly. Like I talked about earlier, those 7,000 strike calls on SPX many months ago gave us a sense that bigger trading desks were confident that this market could continue to make all-time highs into the end of the year. And that's exactly what we've seen. So that's one of the things I think is kind of interesting about options. Obviously, every indicator that you can use that you find value in is worth looking at. But for me, what I found with options is that a lot of these are about where people think things are going to go rather than where they've been. The majority of the indicators that we tend to look at are backward looking. Moving averages, volume profile, or any of those kinds of things are based on what's already happened, whereas options positioning is based on what's expected to happen. So I love to add that into my process. We are seeing some pressure here, futures falling to new lows, sell side stop run of 213 contracts as well. Oh, and ships, I didn't see your earlier query there. I feel like gold went so high and then reverse that was tough to swallow. I that is the way that these things trade. They are beta beasts when they get going. So precious metals spent like a decade basically being boring and forgettable. You could fall asleep watching them trade. And then they just woke up and turned into that high beta beast mode that they go into, which means they can rip face to the upside and they can crush souls to the downside. And that's the environment we're in. It means that you have to be careful about how much you size your positions because it's trading with a lot more volatility than it had been. This is a different regime. And that gives me an opportunity to quickly touch on something that I think is very important: regime awareness. Be aware of the trading environment you're in. Be aware of the personality of the asset class you're trading. Be aware that these things can shift and you need to adapt your strategy accordingly. So when we emerged from a sleepy gold environment to one that was much more dynamic, if you were trading that, you had to reduce your size because otherwise the volatility could absolutely grind your portfolio to dust over time, especially if you're employing any leverage. And most of the traders that are trading short time frames are. So that's why I kind of tried to word that message accordingly. For swing traders, it's obviously a lot different. You likely have a higher threshold for pain because you have a higher duration of exposure, but you also likely have much less, if any, leverage at play. So we have now just about a 9 handle opening range. I call it a 10 handle opening range in the S&P here. Starting to look a little bit more dynamic, giving back some of those pre-market gains. I'm going to switch our views here for just a moment. I want to show you all something else. Give me just a sec to pull this up. Okay. So this is the S&P futures through my dynamic pivots. And the reason I wanted to show this is I wanted to highlight a few things. First, we've got this formidable resistance area overhead, the call wall at 6933.50. There's also some secondary resistance, kind of like a junior call wall, 6928.50. So that confluence area is formidable resistance overhead. And you can see that off this rejection here. So these are areas where the market really hasn't explored, but you have options market generated information that we can utilize to draw support, resistance, and otherwise that can be helpful in areas like this where we're exploring price levels we have not been to before. So those expectations derived from analyzing the SPX options chain can give us more data. But going into the open, this is a pretty constructive look. You're spending a lot of time above the BGL, and you can draw your own BGL if you want. It's a big green line. It's an EMA 21 on a 5-minute time frame. As long as you're above the BGL, your intraday momentum is generally pretty good. You also have these fair value gaps. The blue triangles facing upwards, those are bullish fair value gaps. The magenta triangles facing downward are bearish fair value gaps. That can give you a sense as to bullish and bearish aggression. And then finally, the subchart gave us a little bit of a sense that we're getting a little extended here with this move right before we rolled lower. And we do have some pretty chunky support down below at 6908.50 from key 1 plus. That's a positive gamma level. In fact, most of what you're seeing here is positive gamma because of how far up we are in terms of price. So we'll check back in on this chart in just a little bit, but I wanted to just give you a sense as to we do have formidable resistance overhead. So we may need to consolidate some of these overnight gains before we can try to make a continued push. So Loki asks, are we cutting tomorrow? And if so, should we buy stocks? So I would say For one, I think it's quite likely that the Fed cuts by 25, and the market reaction on Fed Day, or Fedness Day, as I like to call it, can be quite mixed. So I wouldn't necessarily lean too heavily into trading that day as much as I would look at the opportunities that come out from the following days. Because remember, tomorrow is Fed Day. It's also Meta earnings, Alphabet earnings, Microsoft earnings. So there's a lot going on. So I wouldn't be super duper aggressive into tomorrow because you have in a week like this, you absolutely have to have zero bias at all because things can change on a dime. You've got three of the most important tech companies reporting as well as a Fed meeting. So I don't expect a lot of fireworks or surprises out of the Fed meeting. Trump even this morning said Powell will be gone in a few months. Now, it's more likely to be May of next year. That's when his term expires. But Powell is kind of like a lame duck Fed at this point, and he's really given up on the idea of 2% inflation. So it seems like he's comfortable cutting as long as the inflation isn't picking up again, but we're averaging around 3%. So much for 2%. Bye bye 2% goal. Here's the 3% in front of us. That's the world the Fed's willing to cut into. It is dangerous. That is to say that you're creating cheaper money, which can foment demand in a time when inflation is already somewhat elevated and sticky. But I don't think that's going to dissuade Powell. I think he'll say in the absence of data, they have the confidence that they'll cut here, and then they'll, as they expect the government will probably reopen over the next month or so, they'll have more data to parse to determine what they want to do in December. But they've already made their pivot to cutting. And once the Fed already pivots to one side or the other, they typically go several more times before they pause again. So I do suspect this Fed's going to cut again in October and in December. I do suspect that the market will react bullishly over a longer time horizon. But what I'm trying to emphasize is it's very difficult to have a lot of confidence when you've got Fed Nest Day, 3 Mag 7 earnings, and the potential for anything to kind of turn on a dime and have an exaggerated impact during those times. So my thought would be I'd be more comfortable waiting till Thursday or Friday to really make those trading decisions because then we'll have a lot of that information behind us. We'll be able to parse it more clearly and it won't feel as much like a gamble. And Loki says, "Thank you for answering my question. I usually don't ever trade when Powell is too powerful, but I needed to know your thoughts." Yeah, it's just for me, it's just best practices not to get too aggressive into Fed Day. I might do some, like smaller trading on the peripheral. Often is the case, for example, that gold gets beaten up a bit on Fed week. This week being no different. So sometimes, taking fade trades in gold as like a swing for the week can be a high probability winner. That hadn't been working so much over the last year, but it seems to be working again here and now, and it could continue into the end of the week. We'll see. But that's been a more reliable Fed week trade, and it's also because it's not centered in the equity market. I would say the Fed's decision and statement takes about 2 trading days for the market to fully parse. Same thing with earnings. A stock's earnings typically take about 2 days for the market to fully parse because you got to think there's decision makers, they're going to have meetings, they're going to figure out what they want to do with their risk strategy for the market for these single stocks, if there's any impact, if they want to put more on, if they want to take some off, rotate to different parts of the market, etc. All that has to be parsed. And there's still humans making a lot of these decisions for those larger funds. So we are seeing a continued grind lower here. We just got a bearish fair value gap as well. So just wanted to put that in. That just means that this candle opened below the last candle's close, and that's showing you some bearish aggression. So we talked about some pretty good support down here around key one. We're going to be watching that closely. And we should start to see some of the SPX options flow coming in pretty soon. So I'm going to start taking a look at that. Getting another bearish fair value gap. And that 5 minute candle just about 6 minutes ago, that was pretty aggressive sell side delta volume. I have the candle set up here to show delta similar to Bookmap. Also, remember we talked about the subchart showing some sort of exhaustive upside momentum here. That was another clue that maybe we could see a little bit of de-risking. I'm still overall constructive on the tape today, so seeing us retrace last night's rally is actually good. That's really what you want to see to add some more potential for dynamism in this trading day. I don't really want to see the market just go up, up, and away. I'd much rather see a retrace that gives us an opportunity to bid if we see a reversal. That, to me, would be a more constructive opportunity. And we are getting that opening range that I really like. That is to say, we're very close to seeing 15 plus handles on S&P for the 20-minute opening range. That's the time frame I like to watch. And there you have it, just about 15 handles on that opening range. So that is getting a little more juicy for a day that could be fun to trade, a little more dynamism in the price discovery. And I've been asked to check on Bitcoin. Bitcoin is having a nice rally. We talked about this one just a little bit earlier in the pre-market, that it had a recovery that started before gold, basically around, basically around 2 a.m. last night. Big bid came into Bitcoin. So it had been down overnight. We saw that bottom out. And then it really has been a lot of buyer aggression. You can see by the size of these bubbles, the larger they are, the more aggressive the one party that's defined by the bubble is. In this case, we had some very aggressive buy side transacting, and that helped to power Bitcoin higher. So it's not just about the aggression in a nutshell, it's also about the overall trend. You could see the potential that we're consolidating, trying to build a bottom. You see buyers start to get more aggressive, they start to absorb some of these offer zones. And really from there, we started to make a push higher. Now we're breaking above the point of control, making new regular trading hours highs. So it does look like Bitcoin's got some room higher here in this session. And I would like to also take a quick look at gold. And gold's kind of doing similar things as Bitcoin here, but not quite as convincing. That is to say, it's well off the overnight lows, but it's not getting the kind of bid that we saw from Bitcoin. So gold up about 1% off the overnight lows, now pushing above its point of control. Let's check on silver as well. And we're going to zoom that one out. So silver kind of had a similar look as gold, but it looks like it's getting a nicer bounce off those lows overall. It looks a little more constructive in terms of the chart. And again, I'd really like to see silver close this week above $48 an ounce. I think that would be a great omen for bulls. Even if we consolidate around that level for 3 months afterwards, I'd like to just see the monthly chart close above 48 so that that breakout doesn't look like it was a fake out. Now let's move back to the S&P futures. We can see we've made new lows. We're now with a 20 handle, 20-minute opening range. So we do have the potential for this to be a somewhat exciting trading day. Let's also take a look at our high beta beast cousin of the S&P, the NASDAQ. NASDAQ also having not quite as a well-defined trading range as the S&P. This is just about a 60 handle opening range, but it's still interesting. Got a lot of liquidity offered overhead on the NASDAQ as well. For the amount of order book depth that this thing has, you can see it's about 8,000. Seeing that much on offer overhead is at least worth noting. And this is a chart that does, at least for now, look like a micro downtrend. That is to say, lower highs and lower lows so far. That last low, 112 contracts from buyers stopped out. And we're starting to get our flow in. Initial flow for the S&P 500 is bullish, 15,000 contracts between the two most active call strikes with a put call ratio of 0.58 so far. So the opening flush that we saw does have some growing potential that it could reverse. And if it does, I wouldn't be terribly surprised if we at least give this call wall a college try. That is to say, we reverse and rally up to there and probably grind sideways. That would be my thought if this flow continues as it is right now. Because right now you've got 15,000 in the two most active calls versus 4,000 in the two most active puts, and calls are trading just about twice as active as puts across the whole chain. And we do have some more news out of the circular AI deal theater this morning. Microsoft holds an investment in OpenAI Group valued at 135 billion, and Microsoft says OpenAI is contracted to buy incremental 250 billion of Azure SVCs. So basically cloud presence. Let's take a quick look at the S&P 500 heat map as well. Just going to bring this on screen. So this is a pretty interesting heat map overall. And that is to say, there is a lot of distribution underneath the surface here outside of tech. Microsoft up almost 3% on that OpenAI headline we just talked about. NVIDIA benefiting a bit from that. Broadcom, Intel also getting a bid, Tesla, Netflix. But the rest of the market has a bit of a risk off feel to it in both the high beta sectors and the defensive sectors, like utilities, consumer defensives, healthcare, etc. Pretty interesting look overall. Also, Qualcomm, after announcing that it was going to be building AI chips to compete with NVIDIA, now seeing a drawdown of close to 4% in today's trading. I've got a question about UB. I tend to look at ZB since UB is just the leveraged version. But what time frame are you looking at the 30-year bond futures? And Margie, I would say it's actually Bitcoin that's chaotic rather than the heat map. It really is a very high beta trading vehicle. The heat map is simply allowing you to zoom in more on what's happening if that near-term liquidity. But in terms of trading vehicles, crypto is always going to be the more erratic, the more volatile than, say, an equity index or a commodities contract. Obviously, there's exceptions to that rule, like when there were the sort of on again, off again romance with having extreme tariffs on copper when it caused a big rush up into copper and prices surged and then they crashed. But that's unusual. Those are tail events versus with crypto, that sort of price action is much more standard fare. Let's take a look at the order flow updates here. We've got 18,000 in the top two call strikes versus 9,000 in the top two put strikes. Put call ratio of 0.77, so still bullish so far in the S&P index options trading. And let's quickly talk about today's calendar. Coming right up at 10 a.m., we have U.S. Conference Board Consumer Confidence with a forecast of 93.75 and a previous reading of 94.2. After that, we have the U.S. 7-year auction. And then after the market closes, Visa Q4 2025 earnings. Yes, this is their Quarter 4. They have their own fiscal calendar. And then later tonight, Trump will speak in the APEC CEO event around 11:05 p.m. Eastern. We are seeing bidding firming up just a little bit here on the S&P. We could see the hot call on screen as well as the call wall. We talked about this a little earlier, that I suspected that we'd probably try to target that call wall earlier. We talked about that before the flow was even printing. It's likely something's coming over the headlines now. Order book just completely ghosted, and we had a big spike in volume. So I think some kind of news just printed, but I'm trying to see exactly what that might have been. And again, we are expecting CB consumer confidence at 10. So it could also be the order book is lightening up ahead of that event, but there was definitely some huge transacting that happened just now. Look at that Delta buy candle. That's the most aggressive buy candle this entire regular trading hours session. And when you get close to these events, you can see in the heat map, liquidity dries up. Market makers kind of pull back a bit from their offers and bids near current pricing, which is one of the reasons you need to be very careful trading these types of events. Because your fills, your stop outs, your take profits aren't going to work the same way as more liquid market conditions. So often is the case for me, I sit out of these events, I parse the data, and if there's something tradable in that, I trade that. So I'll hang out for just a few minutes after USCB consumer confidence prints just to digest that data with you all. I will also be back next week, Tuesday, 9 a.m. Eastern, for the next episode of Back to the Futures. If you want to learn more about what I'm up to, visit Traderade.com. If you want to get up to 40% off of Bookmap, visit Traderade.com/Bookmap. And if you want to learn more about the SPX options visualizer tool I built that can plug right into Bookmap, visit Traderade.com/SPX. Data is coming out in 1 minute and 30 seconds. Again, the forecast is for 93.75. For these data prints, you're really looking for outliers. So a print of 90 or below would be pretty bearish. A print of 96 and above would probably be well received. It would certainly take us above the prior reading as well. I would suspect consumer confidence comes in lower than expected simply because a lot of folks are struggling. Sentiment numbers have been in the dumps. But we'll see how it plays out. Got to respect the data in the market in front of us. Just about 50 seconds left until that print. Still unclear what this high volume buy was, by the way. Nothing came across the wires to really signify what that was. 10 seconds till CB confidence. Right in line at 94.6, 94.6. So the forecast was for 93.75. The previous was 94.2. This is 94.6. So not very actionable data for the CB consumer confidence. I think that this just kind of clears the way for the market to continue to consolidate and then start to build off the flow. And as we're looking at the flow here, it is important to note that it is still constructive. You've got 23,000 between the two most active call strikes versus 13,000 the two most active puts. It's no longer 2-to-1. The put call ratio has also come up a bit to 0.85. So it's still bullish. It's not quite as bullish as it was earlier, but it does still suggest that this is a market that could try to climb up to that most active call strike. Also worth noting that the implied trading range here between the most active puts and calls is pretty narrow. So everyone's kind of betting on higher prices so far. I would look to these levels as potential areas of resistance, but I would be targeting that hot call wall confluence area, looking to de-risk about a point below it to ensure that there's more likelihood of getting a fill just in case we reject just below. But again, overall, US CB consumer confidence, nothing to see there, coming in at 94.6 versus a forecast of 93.75 and a prior read of 94.2. Today's tape is likely to be much more about the flow and the headlines. And one thing to note into the latter part of the trading day is you may see some just-in-time hedging. That would mean that you have people that are hedging ahead of the Fed and ahead of some of those major Mag 3 earnings that come out tomorrow from Meta, Alphabet, and Microsoft. So that could pull back markets in that last half hour of trading, as well as could add some risk to the first hour of tomorrow's trading. It's just-in-time hedging. That's people buying SPX puts ahead of an event volatility catalyst. And if the event volatility catalyst goes better than expected, let's say the Fed cuts and Powell seems dovish, you typically have those unwind and it's an initially constructive reaction. Similar with earnings. We also got Richmond Fed. That came in at -4 versus a forecast of -12 and a prior reading of -17. That's better than expected by quite a bit. So I want to thank you all for tuning into this week's episode of Back to the Futures with me, Markets and Mayhem. I'll be back next week, Tuesday, 9 a.m. Eastern. Lock it in. I'll see you then. Have a great trading week ahead. Also, stay tuned for tomorrow. I'll be live for the Fed and for one of the 3 Mag 7 earnings. We will vote on that on X. So check it out. Thanks again, everyone, for tuning in. I'll catch you next time.